Hi, everyone. Let's start this webinar off as we usually do with a question. Are you going to be able to retire in a way that you're comfortable with? What do you think most people's answer to this question is? Well, according to a Finance Buzz survey released in January 2020, about 35% of Americans have no money set aside for retirement at all. My question is, why do you think this is? This is always a hot topic for me. And of course, many people just aren't making enough money to save, which I'm sure that a lot of people would contribute to that. But I believe that a good percentage of them would, if they could, wrap their heads around the fact that this is possible for them to accomplish. If they understood that that was what was needed, if they completely understood what was needed to achieve this goal, is really that it's really not out of reach, and that more people then would believe that they could do it. And before we end this webinar today, I'm going to show you a scenario, and just one of many, obviously, where my contention is that over a 20-year period, someone even in their mid 40s or even mid 50s could save enough to have a successful retirement, which is important because so many of us don't really start taking it seriously or get in a position to save for retirement until those later years. So it's really a passion of mine to be able to really enlighten people into the fact that it is possible for them to meet these goals if they have it in perspective and it seems realistic and doable. So I'm so excited to be doing this particular webinar too today, because our topic is introducing investing, and it's the first purely investing / retirement planning topic that we've covered to date for the first 12 months webinar commitment that we've made for this upcoming year. So I'm really getting to sink my teeth into what my passion is. I just wanted to start out our series of 12 webinars with some more general topics and some things that I thought people would have some interest in. But also I wanted to iron out all the wrinkles that could potentially go on during a webinar before I really started to get into these types of topics where I don't have any co-hosts, because it's really in my own wheelhouse. So I just want to let everybody know that I've been holding off to unleash this till now, and I'm excited that so many of you guys really are taking the time out to do this with me. My name is Brian Dougherty, and I'm your host for tonight, but I'm also, my firm is also called PLC Financial Solutions, which is an independent insurance brokerage. And I am also an investment advisor representative with Fusion Capital Management, located in Dallas, Texas. Our office, PLC's office, is located in Fort Washington, PA, just off the turnpike. In fact, you can see the turnpike from our office window. I'm flying solo tonight too, because of one, I'm actually doing this from Cape May, New Jersey, on my laptop, on vacation with my family. I'm in our room, and our family's out there waiting for me to get this thing over with, really. And number two, because Rachel, my beautiful partner in both business and life, I told her she could have off this week for this webinar because we're on vacation. So you just got me for this time. So I want to thank everybody so much for joining us tonight, and for being the type of people that want to better yourself with this type of information and knowledge. It just says volumes about anyone who would spend a beautiful summer day or early evening really taking the time out to learn about this particular topic. But before we get started, let's just cover a few basic housekeeping items here. First, if you take your cursor and you move it around, you hover it around, you'll see that there's an area that's green and red. That one says stop your share, or it says your screen sharing. You'll see some boxes pop up, and one of them says chat and the other says Q&A. These boxes are the boxes that are for you guys. If you have any comments, please put them in the chat box. Or if you have any questions, please put them in the Q&A box, and we'll address them. I'll address them accordingly. Because we have a decent amount of material to cover, usually my format, I usually just revisit the questions towards the end. We have a allotted area to be able to address questions, and I'll do everything I can to get them all in before we end this tonight. If I miss any for any reason, we have allotted about an hour's time for this, then I'll definitely email you the answers and reach out in that way. So, two, this webinar is being recorded. So if anyone gets by, it gets to a part where they didn't hear something, or they or wanted to ask me to reiterate something, you don't have to worry about that. I'm going to be emailing it to everybody who registered for tonight's webinar. And in fact, I still owe everybody last month's webinar, so I'm going to send them both out at the same time. So just sit back and enjoy the show, as they say, and you'll have plenty of time to view this at a later time at your leisure. The third item is, it's my obligation as a financial advisor and a fiduciary to inform you guys that our RIA disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, which I mentioned before. And they're an SEC registered investment advisor. We only transact business in states where we're properly registered or are excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have the potential for profit and loss. So now, Guy, appreciate you being a little patient with me to get that out. So now we've gotten that out. Let's talk a little bit about what it means to invest. So most of us know someone who's either born into or stumbled into financial security, and it's hard not, obviously, to want that for ourselves. But the reality is, for the rest of us, financial security is not a given, and waiting around for a windfall is certainly not the responsible way to go about it. So it's really our responsibility to attain it on our own, and that's what really we're talking about today, and that's what investing is really all about. Us trying to fulfill that responsibility to ourselves and our families with our own hard work. So don't get overwhelmed here with anything that we go through. I'm going to show you all how to have the money that you already have now work for you for the future. So, and that's really what investing is. So you don't have to be a market wizard or obtain financial well-being. You just really need to learn a few basics, form a plan, and then really just vow to stick to it. Investing is not a get-rich-quick plan or scheme. Real investing is not. It's really a long-term investment in your future. There's no guarantee that you'll make money from all investments, but if you understand the best ways to invest and save, you should be able to at least grow your financial security, while you're learning the benefits of money management. So that's certainly an important perspective to take when it comes to this particular topic. So, and you're never too young or too old to get started with this. So there's many ways to invest your money. You could own a business, or you can buy a home. Any of these types, those particular investments, and lots of different ones have the potential for high yields or over a long period of time, which by definition is what investing is. And they're wonderful ways to invest in the future. But for this webinar, we're really going to be discussing investments that revolve around investing in the stock market. So just in case you're getting a little intimidated, or you're intimidated yet even just with the idea, or feel overwhelmed with investing in general, just want you to know you don't have to be. Even the best investors in the world, they have to start somewhere. So that's what this is about. This is kind of like investing 101, and we'll really just want to give you the basics. So you really kind of like, it's like getting in the car and you know where the where the ignition is, you know where the shift is, you know where the brake is, you know where the emergency brake is, you know where your speedometer is. You're just getting yourself familiarized with all the aspects that you would really want to know exist, so you're at least comfortable in the conversation. So whether you're getting started or just now, or at the height of your career, or planning your retirement, or really even in your golden years, like I said, it's never too early or too late to start investing. And the best place really to start is to really ask yourself two questions. Number one, where do I begin? And number two, how do I begin? These questions in and of themselves really could be overwhelming. There's a lot of information out there, and the investing world's terminologies really don't help things much either. Just the term portfolio, for example, really has different meanings to different situations. And you may hear terms like, market capitalization or return on equity. So none of these scream welcome to the world of investing really to anybody. There's a lot of terminology out there that is really to a lot of people just leaves them at a loss as to what they're really referring to. And so it's webinars like these that really can kind of at least introduce you to some of these types of things. So before we jump in to get started, let's take a quick look at and this is something that I don't want you to, we're not going to get too deep into, but I just wanted to give you a perspective on just what drives market trends to help you kind of get a better understanding of where risks come from in the financial markets. So, contrary to what you may understand about the stock market, it's fairly consistent despite the swings you hear about, like on the news. And you'll definitely come to understand just by knowing a few simple things about how it works in cycles. So, here's really from an economic point of view, the three most basic cycles that you need to kind of just understand are out there, and that are really what's behind most of the market ups and downs that you see. The first is kind of a simple concept in economics. It's called productivity growth. And it's just really built around, number one, the measure of labor, and like the input in the money that's going into the labor force, because we're all out there and we're working and we're taking in money. And that's part of the process. How many people are out there in the labor force right now taking in money? That's going to affect, obviously, the economy. The more that are out there working, taking in money, the more they're going to have to be able to feed the economy with. That's known as input. So, and then there's revenue and something called, I'm sure a lot of you have heard before, the gross domestic product. And that's known as output, meaning once people take in this money through their work, then they take it out into the economy and it becomes revenue to the economy, and it drives the things we're buying, and the things we buy make up the gross domestic product. So that's just a simple understanding of how the economy ebbs and flows. So paying a little bit of attention to that, that's known as productivity growth. And then there's two cycles that you really want to kind of understand are going on. First is known as the short-term debt cycle. Okay, and this is all going to sound a little familiar. I don't want you to get bogged down by this at all. I just want you to understand that these three things are what are driving the financial markets, and that you'll need to make decisions based on what you hear about what's going on in these cycles. So this short-term debt cycle is defined by a growth period and then a recession period. It lasts roughly 5 to 8 years and accounts for the boom and then the bust of the market. So it peaks when interest rates go up as loans become more expensive, and then it busts when causing the debt payments, when the debt payments become higher than the income that is out there. Once we make it through that cycle in any 5 to 8 years, and the cycle resets. Those interest rates fall, and it starts all over again. And then there's the third cycle, and that's the long-term debt cycle. It's very similar to the short-term, okay? But the highs and the lows are great. So what happens here then is the long-term debt cycle has a boom and a bust, but obviously bigger, and it takes anywhere from 30 to 50 years for it to hit its peak and then fall. It's a pretty long time. And it actually is driven along with what long-term treasury bonds, which are 30 years. It takes 30 years for any particular treasury issue to run its course. So if a 5% bond, 30-year treasury bond, which we haven't seen in a while, were to be issued, it would take 30 years before that bond came fully mature, and then the new cycle started. So there's, and it's basically the same thing. It peaks when the economy has high debt. It can't take on any more debt, which means the economy cannot continue to lower interest rates anymore. So when it gets to that point where it falls and they start lowering interest rates now to get it generated, there comes a point where they can't lower them anymore. And then that starts the turnaround of the cycle. And a lot of people think we're at that point now, where just last year, the Fed fund rate, which drives treasury bond rates, was from 0 to 0.25 of 1 percentage point. It's as low as, without getting into negative interest rates, which it's a whole nother ball game. It's the lowest point, one of the lowest points we've been at. I think 2016 was the last time prior to that. So keeping an eye on these things is important, because they should drive some of the decisions you make. Now, when you think about the long-term debt cycle, think about like the roaring 20s and how things were just so great in our American economy. And then the bottom out of the 30s and the 40s with the Great Depression. There's a cycle that took 20, 30 years. So, and played out over 20, 30 years. So the trick to navigating these cycles is to get an understanding where your personal situation is in relation to these highs and lows. For example, if you're in your 30s or 40s and you're investing on a regular basis, say in a retirement account, 401k, IRA, whatever it is, or even a brokerage account, and you're not going to need access to your investments for 5 to 7 years or more, then these cycles aren't going to mean quite as much to you, because there's a very good chance that when they bottom out, you won't be in a situation where you need those assets, and you'll be able to sustain the time period it takes for them to come back around. So, but if you're in a situation where you're, say, within 5 to 7 years of need or of retirement and may need access to your investments, well, then within that period, you might want to think about starting getting more defensive in your portfolio and starting to defend versus allowing things to just ride. So just a little, don't get bogged down in that too much. Just a little bit of background for the things that relate to the economy and the market that you should just be kind of paying attention to. So, now that you have a better perspective on that, on the markets and how they work, let's now talk a little bit more about what a portfolio is and why. So, for many of us, the word even portfolio brings to mind like scary interviews or long nights compiling our life's work into a comprehensive presentation. But in the financial world, your portfolio is simply the things that you own. That's it in a nutshell. So it includes things like your retirement accounts, investment accounts, which could have stocks, bonds, commodity investments in them, mutual funds, ETFs, all different kinds, real estate, business assets, really just anything you own. In fact, most of the time people are at work building a portfolio with really not even knowing that that's what they're doing. But the trick is to have a clear vision of your portfolio. That's a good idea, because then you can create a balanced portfolio that limits the possibility of losses in case any one of those investments or the markets related to those investments falls at any given time. So at some point, you really want to become conscious of the things you own and how they fit into your overall portfolio or financial plan, so that you can protect yourself from this situation. So it becomes a method then to your madness when it comes to the things you own. The number one thing when it comes to doing that is, and the best idea is, to diversify it. So when it comes, and also when it comes to diversification of your investments, it's not only a really good idea to diversify individual investments inside a market-based portfolio. And a market-based portfolio really is a portfolio that's made up of either individual stocks and bonds, or mutual funds and exchange-traded funds, also known as ETFs, that are just based on equity and the bond markets. But it's also a good idea to invest in assets that don't correlate very much with each other, and don't correlate with the equities in the bond markets. So in fact, what a lot of people don't realize is that portfolios being made up of mainly equities or stock-based investments like mutual funds and ETFs, individual stocks, and bonds, made up of various types of bonds. It could also be bond mutual funds and bond ETFs, or various types of debt instruments that are out there. They've been joined together in most portfolios because they don't historically have not correlated with each other. So when one market is high, the other one is not necessarily low. And when one is low, the other one is not necessarily low. It may actually be high. So that's what you want. You want investments where one can be high and one can be low and another one can be high, or multiples where at any given time, unrelated to each other, several could be high while others are low. And so that leaves you less vulnerable to any one particular market and the highs and lows that happen as a result of it. And other ones that are non-correlating are things like real estate. Something you hear a lot of terminology is something called a REIT, a real estate investment trust. That's generally how they create investment pools of real estate investments in one concentrated area that we can invest in. And they even have funds that invest in these and ETFs that invest in these things as well. There's also another one is called commodities. You may hear about the commodities market on the radio, but really don't, or TV or whatever it is, and really don't understand, well, why is it important to invest in a commodity? Well, first of all, what is a commodity? A commodity is, there are things that are sold on a market, like precious metals, gold, silver, coffee, grains, gold, beef, oil, and natural gas. They're commodities. So, and don't necessarily correlate with real estate, stocks, or bonds. Another non-correlating investment that's popular is our collectibles. Not quite as popular, usually for people with higher assets, as we all know, but things like art can be viable investments and can appreciate and depreciate. Stamps, baseball cards. We all know that there's, Babe Ruth rookie card out there that could be worth $1 million now. Who knows? So, and they are viable investments depending on the amount of assets that an investor has and how in depth they want to get with their portfolio and how serious they are about creating non-correlated assets within their portfolio. Believe it or not, it came across wine is actually a commodity that has its own market. So there are various non-correlating investments that can be part of a portfolio and should be considered to some degree for anybody's portfolio for the purpose of having a method to your madness to protect yourself from the lows of each different market. So let's talk about why diversification is important. So everybody remembers the great credit freeze out of 2009 that resulted in almost the near collapse of our global financial economy and what's known as now as the Great Recession these days. That recession period also meant complete financial annihilation for an incredible amount of private investors that took advantage of a boom just before a bust. And their timing was just not right with it. The problem for so many who lost was that they had imbalanced portfolios. Essentially, if you put all your eggs in any one basket, like they say, then you stand to lose it all if something takes a turn for the worst when it comes to that basket. In fact, really, it reminds me of a few years back, a client of mine, when we first met, she had half of her work retirement plan invested in her own company's stock. It was over $200,000. when I saw it, my eyes almost popped out of my head. And I was immediately, light bulb went off, and I knew emergency light, and I knew we had to make a move with this soon. We did. We moved it to a more diversified portfolio, and that was about a year and a half, 2 years before she was planning on retiring. The irony of is about 6 months prior to retiring, her company stock dropped to less than half. Fortune 500 company. It was all due to market trends, and it did eventually bounce, but it didn't bounce till after she was already going to retire, and that would have caused her to delay her retirement. Who knows how long, really? So that was an experience I had with this concept in particular, where diversification wasn't thought of in advance enough, and probably some changes needed to be made. I would have said 3 to 5, maybe 7, 5 at least years prior to retirement. So first step to investing is really getting clear on your goals. So of course, we all want good returns on our investments. And I mean, that's a given, of course, but you personally must ask yourself these questions before you consider different options. First question, and it's plainly obvious, is why are you looking to invest? You need to determine if you're focusing on safety, income, or even growth for that matter. The second is how much can you realistically set aside for your goal? So, obviously this is going to involve, putting together a budget, see what you have available to invest without compromising your current financial responsibilities. Third, when will you need this money again? It's a big question. Are you saving for retirement, which is long-term, or for a car, or maybe even a down payment on a house, which are both more short-term in nature? Fourth question, how much risk can you or your situation tolerate? That has everything to do with what you are going to invest your money into. So obviously, last question being, what then should you invest your money into to achieve your goals? So for instance, and I have a question for you guys. So if you intended to sell your home and will be looking for a new home within the next 6 months to a year, would you want to put that money into the stock market or into a cash or cash equivalent type of investment with say like a short bond fund with very low fees, or even a high interest savings account? If you could, put the answer to that in your comments. Love to see what your thoughts are on that. Well, it'd be my vote to put it into cash and cash equivalents, because if there was a major loss in the market just before you needed that for whatever, a home or a new car, obviously you'd be putting off your purchase for a while. So with all that in mind, let's look at the most relied upon investment vehicles and options available today that really all people should consider when it comes to meeting their savings goals. So when it comes to investment vehicles, if you work for a company offering, say, a 401k sponsored retirement plan, or an employer sponsored retirement plan like a 401k or 403b or 457b, etc., that could be a great opportunity to start your financial savings plan. Employee 401k contributions are usually based on a percentage of your income that you get to decide on, and it's automatically deducted each pay period prior to taxation coming from your gross earnings. Also, many employers will even match your employee contribution up to a certain percentage. So, for instance, if you were to say, if they were to say, well, we're going to match up to 3% of your salary if you save up to 3%. So if you were to invest, say your salary was $50,000, 3% of that is $1,500. By the time you put $1,500 into that account, your company will have already matched it with another $1,500, and now you have put, in essence, 6% of your salary into that savings account. Now, that doesn't mean you have to stop at 3%. You could put 6% of it in. They're only going to match it up to the 3%, but as a result, by the end of that year, you'll have had 9% of your income invested into that plan, and you only put in 6%. So I always encourage all my clients who have this available to them to at least invest up to what their employer will match, because it's really like getting a boost on your income or free money put in your savings. So if you can afford to do that, I highly recommend doing it. So, there are some drawbacks to a 401k plan versus an IRA, which I'm going to talk about in a minute. But if you have access to that 401k and there is a match privy to any type of retirement plan, and then an IRA or an individual retirement plan may be something that fits the bill for you, and it's something that you can start in your own personal bank. It can be you could start it with a mutual fund company. You could start it at a brokerage like TD Ameritrade or Schwab or one of them. Sign up for an account there, and you can open an IRA. Let's talk about an IRA a little bit. So, obviously, it's a great retirement plan option if there is no employer sponsor plan available, but it offers tax-deferred growth on your investments, so you're not going to pay any taxes on the growth as you go along. And there are also a couple of different types of IRAs that you should consider. But there are also some things that you need to know about it, like it's more limited than a 401k in terms of how much you can put in it or you can contribute it in any given year. Generally, a 401k today for someone who's under age 50 can put up to $18,000 a year in one. And if you're over 50, you can put up to $24,000 a year in. And there is no income limitations related to it. For an IRA, it's only $6,000 that can be put into it in any given year if you're under 50, and $7,000 for another extra $1,000 for a catch-up if you're over 50. So it's certainly limited, and it can actually be limited in terms of it being tax deductible if you have an employer plan like a 401k available to you and you're not taking advantage of that. They can actually restrict whether you can deduct that IRA, which then makes it tax deferred on your tax return. So if you have a plan available at work, they really encourage you to want to use that first and then contribute to an IRA after. Like, for example, if someone wants to just contribute up to the match, and then use an IRA, which has a lot less restrictions on when you can take your, if you can take your money, in an emergency situation. Both of which, though, you would be penalized if you took it before age 59 and a half. But some 401ks won't even allow you to take it, even if you're willing to take the penalty. So it definitely has more restrictions. And if you don't want those restrictions, then you maybe just want to save up to the match in a 401k and then save the rest in an IRA if you're happy with how much you have to save. If it meets your needs in terms of how much you need to save for retirement. The two types of IRA choices that you have are, one, a traditional IRA. So a traditional IRA is a good choice for anyone who, with earned income under the age of 70 and a half, you cannot, 71 and a half, you can't contribute after 71 and a half. And it may or may not, like I said, be tax deductible based on whether you are covered under a work-related plan or not. But most of the time, if it's done right, it can be. And like I said, you're not going to pay taxes on any of that growth until you access it after the age of 59 and a half. Then you're going to pay taxes at the ordinary income level, whichever it is. And the theory or thought behind it is most people, when they retire, go in the lower tax brackets. So it's more advantageous to draw off them when you're at that time of your life. The second is a Roth IRA. Roth IRA is you put post-tax money into it. It's already taxed. All the growth is still tax-free. And the beauty of it is you take all the money out tax-free, doesn't matter. It is restricted by your income, though. So for an individual who makes between $125,000 and $140,000, it starts to phase out whether you can contribute to it by $140,000. And after $140,000, you can't even contribute anymore. And then if it's a couple, it's from $198,000 to $208,000 that phase out. So, but an excellent, if you fall within the right income level, an excellent vehicle to save in to really minimize taxes at a later date. So let's talk about some of the specific types of investments. Just getting very basic here, understanding stocks a little bit. So little background, stocks are called shares and equities, different names you hear them called. Same exact thing, they're referring to stocks. They're investments that represent a percentage of ownership in a company. So if you purchase a stock at a company, you become a shareholder, even if it's only one share. Your rights as a shareholder may include dividends that are paid, and they're derived from company profits that are shared, with the shareholders. And you also have voting rights. Most people wouldn't know what to do with them, unfortunately, but there are a lot of qualified investors out there that own fairly decent percentages of businesses that do and want to have a say who's in running those companies. And even somebody with one share, if they want to have a say, they can. Stocks are made available when companies issue shares in order to raise money for their business capital, which turns into profit, hopefully, and then ultimately more is paid out to the shareholders. Pretty basic. But if a company goes bankrupt, shares can't be sold to repay debts. So you do stand to lose your money or your investment when you invest in a stock. And so there is a real good risk of that happening, especially if you invest in IPOs, initial public offerings, new companies. A lot of people lose money in those types of stocks. So, what are the different types of stocks that exist out there? Well, really, you got two different types. You got common stock That's the one that shares in dividends and voting rights. You got preferred stock. Preferred stock's a little different, works a little differently. Shareholders typically do not get a vote when it comes to shares. But in exchange for not having that vote, they are guaranteed when shareholders are paid dividends that they get paid dividends first. So if there isn't enough to pay everybody, they'll get paid theirs, and the common stock may not get paid. So common stocks are generally riskier than preferreds because if they declare bankruptcy also, assets are sold, preferred stocks get paid before common stocks. But generally, common stocks have greater potential for growth, and in the right company, probably are more valuable than preferred stocks. So let's talk a little bit about bonds, another investment option. We talked about non-correlating. Let's talk a little bit about how bonds work. Unlike stocks, that are equity investments, bonds are actually debt investments. So a bond is a debt investment that entails an investor loaning money to either a corporate or a government entity. And the funds are borrowed for a set period of time out of either a variable or a fixed interest rate. Often this is considered guaranteed money because they're a very low risk option for investors. And bonds always get, bondholders or debt holders in a company always get paid first, even before preferred stock, when it comes to when it comes to a company that went out of business. So when bonds are issued by a company, the investor, who's also known as the lender, typically gives the company a set amount, let's say $1,000, which is a normal denomination that you see, and that's known as the face or par value of the bond. And in turn, the company promises to pay the investor a certain interest rate, known as the coupon rate, every year. They do this in addition to repaying back the $1,000 principal loan or par or face value amount to the investor when the bond matures, in whatever period of time that is. So let's take a closer look at how that works. Say we invested that $1,000 in a 30-year bond. This is the time span known as the duration of the bond at 5% interest or coupon. That would mean a $50 payment each year, and it's usually paid out biannually every 6 months, say $25 every 6 months. And then at the end of the 30-year period, the $1,000 is returned to the investor. Bonds are a great option for balancing your portfolio because they definitely help lessen your overall portfolio risk, and they provide an opportunity for consistent gains that are guaranteed with the bond. They also are less volatile than stocks, although they are volatile and based on the market, and the values can go up and down, and you can lose money on the par value of that bond if you sell it before maturity, if the rates in this particular case go up higher than what it was when you bought it. So there is some risk definitely with it, but a lot less risk than with an equity. So let's look at the pros and cons related to bonds. So the pros, they're fairly safe investments designed to provide you with regular pre-scheduled payments. If it's a corporate, not a government issued bond, the bond then the company the bond declares bankruptcy, you'll be the first to receive compensation once the company's assets are liquidated. So even if interest rates decline, you're still guaranteed the higher rate when it comes to the company paying you, even in a situation where it's liquidated. The cons are, number one, the interest payments from bonds are taxed higher than other types of investment income. They're taxed at ordinary income tax rates. opposed to equities being taxed at a capital gain rate, which could be, depending on when you cash them in, substantially less than whatever your current income tax level is. The interest rates increase is tied to lower interest rates. So if interest rates increase, you'll be tied to that lower interest rate the whole time you have that bond. So you're currently receiving 2%, and the market rates increase to 3%. You're still locked in at that 2% rate for the full duration of that bond, no matter what. So there's an interest rate risk, they call that, or opportunity risk. But you do not stand to make as much money for sure than you would in a riskier investment like an equity. So you need to understand that going in. So it's important to create a portfolio that incorporates bonds in a way that meets your own personal risk tolerance, in conjunction with other types of investments that can balance off the risk that you have a good tolerance for. And that's why bonds are usually used with equities in various what they call asset allocations, allocating a certain amount to the equities and a certain amount to bonds, so they offset risk. One of the biggest things right now, if you're thinking about actually purchasing a bond, is that bonds are, like I said earlier, all-time lows, right? 2020, like I said, the Fed fund rate 0 to 0.25. So you really couldn't be investing directly in bonds at any worse time. And the actual, so if the actual treasury bonds generally bear about a 1 to maybe 2% markup to the Fed fund rate. So I checked them last week. A 10-year bond right now is bearing about 1.3%. 30-year bonds about 1.9. So certainly you want to offset, you want to incorporate them in conjunction with other investments in order to create a tolerable risk level for yourself. And so one of the last type of investment that I think is most viable for the most investors out there, is understanding mutual funds, and I really want to add to this exchange traded funds, because they're basically the same in their makeup. They just have a little bit different rules, and they're exposed a little differently to taxes in different ways, which we're not going to get into today. But they're another way to invest and diversify, and they're often the best for newcomers when it comes to investing. So mutual funds are essentially a money pool managed by a fund manager. And many times ETFs can be too, but they also many times are passive in nature, where they just buy all the stocks that are in the S&P 500, and they just follow what that is passively. So that's where they differ a lot, but they do have active ETFs as well that are managed. So they can be like apples and apples, or they can be like apples and oranges, depending on how they're set up. But with a mutual fund, there's always a fund manager that's responsible for investing into the stocks and bonds, which means you don't have to do the monitoring of the investments very closely, or you don't even have to do any purchasing of them at all. You just leave it in their hands, and you go on their track record, which is a really nice element for the average investor, because let's face it, most people aren't going to be very good at those types of things when it comes to investing. Plus, the plus side of choosing mutual funds is also that you can diversify without paying numerous commission fees. Whereas you're making individual investments, you end up paying separate fees for each of them, and a lot of them. And this is the way to be able to invest and diversify. And some of them have thousands of investments or individual stocks or bonds in them without paying any of those additional fees. So one drawback to owning a mutual fund is that they cannot be liquidated until the market closes at 4 p.m. each business day. So if the market is falling like it did last year in April and in March, and it's 10 a.m., market opened at 9:30, and you can put the order in, but they're not liquidating that until 4 p.m. and there's potential for a lot of loss in those number of hours. So I think they're great when it comes to somebody who's in a work related plan, who's doesn't need, who's not living off their assets, who's not in a situation where they're going to need the emergency liquidate. Perfect for that type of situation. But if you get into a situation where you're living off your portfolio and it could lose 30, 40%, in that particular time, we lost it in like 3 weeks. But you're not sure, you could lose 15, 20% in a day, and you see the trend is going on the next day more. You really want to be able to exit that investment immediately to cut your losses and to maybe go back when things calm down. So you really don't have that option in a mutual fund, opposed to an ETF, which can do that. So there are two major things that I wanted to bring up for today. But that's basically your stocks, your bonds, your mutual funds, your ETFs. They're the major investments that most people, in my opinion, should consider. ETFs and mutual funds that involve non-correlating investments like real estate, commodities. There are even some for collectibles and oil and or energy. Personally, I'm not don't advocate much with oil these days. There's been a lot of fluctuation in that as well. It's been doing better lately. I'm really more renewables myself because I think the future is there. But nonetheless, it's an energy related investment, and it can be a non-correlating investment. So they're the bulk of them. Let's talk a little bit where I started this whole thing. Basically, is it possible for someone who has 20 years to retire to invest at a level that's reasonable? So here's an instance I put right into a savings calculator. Someone contributes the pre-age 50 maximum to an IRA, $6,000 a year, putting $500 a month in, or $125 a week if it's coming out of a 401k, what have you. Start out with just a $500 investment over a 20-year period at about a 7% average return, which is what is doable and historically has been done. A little more lately, but a lot of market specialists these days are really thinking it's going to be a little lower going forward because the bonds have been so much lower in their production. So let's call it 7% over that period of time. That person could have almost upwards of $260,000. Now, is that enough? Let's look at the math. So it's $257,000. Historically, it's been thought that about 4% annually could be drawn off that safely for it to last about 30 years. So it would take somebody who's, say, 65, 67, most likely. That's going to be the more popular retirement age going forward. About 30 years, last to about 97 years old. The average Social Security claim today for someone 67 is $1,543 for the higher earner. For a lower earner or a no earner, somebody who's just collecting a spousal income at 67, full retirement age, they would get 50% of that, which is right around $771. They'd be drawing all told between that investment and those Social Securities. This doesn't, of course, include pensions. If you're lucky enough to have one, most people aren't these days, so I didn't include that. Or if you have a rental property or anything like that, like I do myself, any of that income, you'd be looking at around $3,170 a month from what I've seen, average fixed expenses for folks out there today, $2,500 to $3,000 going into retirement after a mortgage is paid off and what have you, still leaves in excess of about $670 a month. Is it perfect? No. But is it possible? And could it be done successfully? Absolutely. So I just wanted, and if somebody was doing this from age 40 to 67, you had another 7 years of that, and that would take it up that much more. So it's absolutely doable, folks. You can do it. And I just want to make that point. So now we're going to wind things up. One of the things that I just want to talk about a little bit, if you came to this event tonight with the idea that investing is risky and that it involves you tracking your contributions daily and trading based on trends to best monetize your investments, or maybe to find out if Bitcoin is the right investment for you. I hate to say this, this was not the event for you, okay? I'm sorry to tell you that the thought that even though a lot of money has been made in this type of day trading and novel investments like cryptocurrency over the years, and a lot of people are doing good in it, when it comes to average investors out there today, these things are just not reliable enough to advocate for long-term investing as far as I'm concerned. In fact, when it comes to, say, cryptocurrency, which is a very hot topic today, and I still can't find any definitive research that has convinced me, and I've been looking for a good reason to invest personally, that really tells me that from a long-term perspective, that this is that these are really investments that can work for the type of investing that we're talking about in the scope of this in the scope of this webinar. So you know, it's not to say that a small percentage, very small percentage, maybe 2 or 3 or 4, 5% at the most of a portfolio can't be put in anything that's a little riskier. You know, that's even a common thought for most advisors. It's just they haven't proven themselves long-term as of yet, because when it comes to the rules of conventional investing, which is in a nutshell, are that investments must show long-term earnings potential and prove that through metrics that it produces on a quarterly, year-over-year basis. So the thought that this type of risky investing is what investing is all about is definitely a common misconception. And, you know, definitely many people do this type of trading and investing, but unless you have the time and are willing to take the risk, buying low, selling high is not the best option for most investors. The average investor is looking for a return with a set it and forget it mentality for the long-term gains. With the market averaging hanging around 7% perspective for the future, you can expect whatever you invest now to gain in 30 years around 7 times your investment when you set it and forget it. So let's recap some of the things we've covered today to help you to create your investment strategy. 1, think long-term. So your long-term financial goals and invest now to secure, set your long-term investment goals and invest now to secure your financial future. Invest in what you can afford. Do your budget before considering your investment so that you know what exactly is left to use to invest. Buy what you believe in. I didn't mention that earlier, but this is something that I think is important. So don't make your investments solely on what you have heard is the best option out there. And not to belittle anything, Invest in something you believe in. And then set it and forget it. The longer you leave it, the better your chances are of a higher return. Contribute consistently, continue to invest into your future, diversify, protect yourself and your financial future by diversifying your portfolio. Set your strategy and watch as you secure your financial future. As a secure financial future comes into view for you. Should you consider a financial advisor? One of the last things I wanted to touch on before we get into some questions. If the thought of doing your own research and navigating the investment opportunities is more work than you want to put into it, or more and more than one you may consider, you want to consider, then you may consider seeking out a financial advisor to help you decide on the best investments for you, your budget, and your financial goals. A financial advisor does come with a fee. So typically some percentage of the value of your assets, but what you get out of it is a professional who will be actively monitoring, evaluating, and diversifying your investments. So if you decide to go this road, it's important that you choose the right financial advisor. It's my recommendation to look for someone who emphasizes comprehensive and holistic financial planning versus someone who just manages investments. Anybody can do that. It's more important to really work with somebody who's going to get to know what your situation's like and customize it to where a plan can be put together that works for you individually versus just investing the money and trying to get you the highest return. That may not get you where you want to get if there isn't a good de-accumulation strategy. So really, I say it all because it's really important that all the phases of your financial life, accumulation, de-accumulation, and legacy planning for things that have to do with tax efficiency when you pass and your assets are left to your beneficiaries, because a lot of your hard-earned investing and strategizing can go out the window to pay a lot of heavy taxes prior to your heirs getting the money. So it certainly should be something that's a consideration for you. It also has to do with where are you in your savings process. That will dictate how complicated are your goals to meet. And so definitely keep that in mind as well when considering an advisor or not. All right, folks, thank you so much for attending this event. I hope this experience has left you feeling more informed about your investments, options, and ready to start planning for your future. Obviously, before we go, like I promised, I'm going to take a few questions from our Q&A now. So let's see what we have. All right. First, let's see. First is, how much do you think the average person needs to save for retirement? Okay, well, I just showed you. It has to be taken into consideration what your other sources of income are, Social Security being the most important one. If it's adequate enough Social Security and expenses are minimized, it doesn't have to be $1 million. It can be a quarter of that. And I've even dealt in plans where people had pensions where it was even less than that. I have clients with $150,000, but they have great pensions and great Social Security. So it certainly is doable at various when all aspects of your situation are taken to consideration, and not as heavy a list as many times it's made out to be. Second, what funds do you recommend most inside a 401k or work retirement plan? Well, this can be a little bit tricky. I generally tell people not to get that complicated. It depends on the amount of time that you have left before retirement. One of the things I can tell you is that I love targeted funds. There are quite a few companies out there, Vanguard, BlackRock, several of them have these targeted funds. So it'll be called the 2030 fund, where if you plan on retiring in 2030, you invest your money into that fund, and it's going to do all the things that you would be expected to do to prepare you to retire by that time. That could probably be one of your easiest choices. Otherwise, I would say maybe you want to consult with a sorry, financial advisor to at least help you navigate the choices and mitigate your risk. You don't want to be too heavy in equities as you're getting closer to retirement. So if you're not given the choice of a target fund, then having a good mix between equity and bond funds is what you want to do. One general rule of thumb that you hear a lot is if you take your age and you subtract it from 100, generally the answer to that will tell you about what percentage of your portfolio to put into equities at any given time, and the difference would go into bonds. So maybe that would be a strategy. So next, third question, what risk level do you advocate when a person is getting close to retirement? Again, takes you back to, could be several factors. One is how much does a person have in their assets? Person's worth $3 million, then certain amount of that should be committed towards having guaranteed income, and if they have a decent Social Security as well, or pension, all those things should be considered. But they can afford to stay a little riskier once those things are taken into account and there are certain guarantees in place. If a person is not in that situation, generally you want to reduce risk to a level that not just they're comfortable with, but that their situation, when it's put into a stress test, can tolerate. I can't really get too deep into how to do that. That's something I usually do with people when we sit down. But that's generally the litmus test as far as I'm concerned. Test their situation to see if it can tolerate certain risk levels. It is a great question, but it's going to differ from one person to the next. Last question. Should I consider buying an annuity for when I retire? I mean, that's a great question. Well, really two answers to that exist. I would say if your expenses and your whatever guaranteed income sources you have, if there's a gap where that guaranteed income source doesn't cover all those expenses, then you may want to purchase an annuity to fill that gap with guaranteed income for your life. And then once you do that, whatever's remaining of your assets, then you could, I would put in a reasonable, probably a moderately invested portfolio, because you may not know when emergencies are going to come up. So again, that's going to come down to your circumstance, whether it would be a conservative or a moderate portfolio, or even a more aggressive. But an annuity to fill an income gap like that is definitely something that's viable. In some instances, because bond investments are so low in return, it's also a viable idea to invest in an annuity, certain types, that can potentially get you a higher rate of return long-term than bonds do. So we refer to it as a bond alternative annuity. So in those two cases, I think it's viable to have an annuity. I do believe these days it's important to make sure that it's the right annuity and the right types of indexing strategies or interest-bearing strategies are in place. Some cases you may not want a fixed indexed annuity. You may want a more of a guaranteed interest rate annuity. They're called MIGAs, right? Multi-year guaranteed annuity. And that would just have to be looked at and see what your preference is. That's all the questions I have tonight, folks. So I want to thank everybody for taking the time out to do this webinar with me tonight. I hope that this was informative to you and helpful to you. And I really hope that it, more than anything, was valuable to you. I also want to mention again that my firm's called PLC Financial Solutions. We're located in the Fort Washington, PA area. You can also go to our website. It's called plcfs.com, or you can reach out to me directly through an email at bdougherty, that's BDOUGHERTY at plcfs.com, or you can call me at 215-804-9708. If you have any questions related to what we talked about, I'd be happy to talk about them with you. You could even set up a 15-minute free complimentary Q&A session to just talk about this or any of the other things. Be happy to do that for you. The easiest thing for you to get me may be just to go on our website because it has all our other information, and that's plcfs.com. That's P as in Paul, L as in Larry, C as in Charlie, F as in Frank, S as in Sam.com. All right, folks, have a great night. Look forward to seeing you again next month on our webinar.